Economic uncertainty is something we've all experienced, whether it's inflation, rising interest rates, or global crises disrupting financial markets. It's easy to feel overwhelmed, but what if I told you that these uncertain times are also some of the best opportunities to build wealth? That's right. History has shown that moments of economic turbulence have often led to incredible financial opportunities for those who are prepared. Think of it this way: when markets are volatile, asset prices often fall, presenting opportunities to buy undervalued stocks, real estate, or other investments at a discount. Additionally, economic challenges force individuals to rethink their financial habits, leading to smarter spending, saving, and investment strategies. For those who stay disciplined and informed, uncertainty can be a powerful motivator to achieve long-term financial goals. In this video, we're going to explore how you can protect your wealth during these challenging times and use smart strategies to grow it. We'll cover everything from building a strong financial foundation to identifying resilient investment opportunities. By the end, you'll have a clear plan to navigate economic uncertainty and turn it into an advantage. Let's begin by discussing the first step: creating a solid financial base to weather any storm. The foundation of any strong financial plan, especially during uncertain times, is security. Before you think about growing your wealth, you need to protect what you already have. That starts with building an emergency fund, a dedicated reserve of cash to cover 3 to 6 months' worth of essential expenses. This safety net is crucial when faced with unexpected situations like job loss, medical emergencies, or sudden home repairs. Without it, you risk falling into debt or being forced to liquidate investments during market downturns, which could lock in losses. When it comes to creating an emergency fund, consistency is key. Start small if necessary. Set aside a percentage of each paycheck, even if it's just 5 to 10%. Over time, these small contributions can grow into a substantial buffer. Make sure your emergency fund is stored in a high-yield savings account or money market fund, where it can earn interest while remaining easily accessible. Budgeting is another essential practice during economic uncertainty. Begin by analyzing your spending habits to identify areas where you can cut back. For instance, you might reduce discretionary spending like dining out, streaming services, or impulse purchases. Redirect these savings toward your emergency fund or investments. A popular budgeting framework is the 50-30-20 rule. Allocate 50% of your income to needs, 30% to wants, and 20% to savings or debt repayment. Debt management is another critical part of building financial resilience. High-interest debt, such as credit card balances, can quickly become a burden during periods of rising interest rates. Focus on paying off these debts as soon as possible. Consider using the debt snowball method, which involves paying off smaller balances first to build momentum, or the debt avalanche method, which prioritizes debts with the highest interest rates. With a strong financial foundation in place, you'll be better equipped to handle challenges and take advantage of opportunities. Now let's move on to discuss how to invest strategically during volatile times. Investing during economic uncertainty can feel intimidating, but it's often the best time to find opportunities. Volatile markets may seem risky, but they also allow investors to buy high-quality assets at lower prices. The key is to approach investing with a solid strategy that emphasizes diversification and long-term thinking. Diversification is your first line of defense against market volatility. By spreading your investments across various asset classes, such as stocks, bonds, real estate, and alternative investments, you reduce the risk of losing money if one sector underperforms. For example, when stock markets are down, bonds or real estate might remain stable, balancing your overall portfolio. During uncertain times, dollar-cost averaging is a particularly effective strategy. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently buying assets, you'll purchase more shares when prices are low and fewer when they're high, ultimately lowering your average cost per share. This approach reduces the risk of trying to time the market and ensures you stay invested. For those with a higher risk tolerance, look for sectors with strong long-term growth potential, such as renewable energy, technology, or healthcare. These industries are likely to drive future innovation and economic expansion. At the same time, don't overlook dividend-paying stocks, which provide consistent income even during market downturns. Finally, remember the importance of patience. Markets may experience short-term dips, but history has shown that they tend to recover over time. Staying invested and focusing on your long-term goals will often yield better results than reacting impulsively to market fluctuations. Now, let's explore specific asset types that tend to perform well during challenging times. Certain assets have a reputation for resilience during economic uncertainty. These safe havens can protect your portfolio while still offering growth opportunities. Let's start with real estate, which is often considered one of the most reliable investments. Properties provide steady rental income and long-term appreciation, even during economic downturns. Real estate values tend to recover, making it a popular choice for wealth preservation. If buying property isn't feasible, consider investing in real estate investment trusts, REITs, which offer exposure to real estate without requiring large upfront capital. Gold and other precious metals are classic safe haven assets. Gold, in particular, has historically performed well during periods of inflation and market volatility. While it doesn't generate income like stocks or bonds, it provides stability and serves as a hedge against economic shocks. Many investors allocate 5 to 10% of their portfolios to gold for added security. Dividend-paying stocks are another excellent option. These are shares of companies that distribute regular payments to shareholders, regardless of stock price performance. Companies with a strong history of maintaining or increasing their dividends, even during recessions, can provide a reliable income stream. Look for dividend aristocrats, firms that have raised their dividends for at least 25 consecutive years. For those seeking alternatives, bonds can offer steady, predictable returns with lower risk than stocks. Additionally, cryptocurrencies, while highly volatile, present opportunities for outsized gains if approached carefully. The key is balancing high-risk, high-reward assets with more stable investments to protect your overall portfolio. Building wealth during economic uncertainty requires a proactive and disciplined approach. Start by assessing your current financial situation. How much do you have in savings? What is your debt-to-income ratio? Understanding where you stand will help you identify areas for improvement and create a realistic financial plan. Focus on education. The more you know about personal finance and investing, the better equipped you'll be to make informed decisions. Read books, watch videos, or even take online courses to enhance your understanding of topics like asset allocation, market trends, and risk management. Automation can also make wealth building easier. Set up automatic transfers to your savings or investment accounts so that you're consistently putting money aside without having to think about it. Over time, these small contributions add up and can have a significant impact on your financial health. Stay informed about economic developments. Follow news on central bank policies, inflation rates, and geopolitical events, as these factors can influence markets and your financial strategy. Adapt as needed, but avoid making impulsive decisions based on short-term fluctuations. Set clear financial goals. Whether you want to save for retirement, buy a home, or achieve financial independence, having specific objectives will keep you motivated and focused. Break these goals into smaller, actionable steps and celebrate milestones along the way. Economic uncertainty doesn't have to be a roadblock to building wealth. By staying proactive, disciplined, and informed, you can turn challenges into opportunities and secure your financial future. Thank you for watching. Don't forget to like, subscribe, and share this video. Until next time, stay financially empowered.